In Currency Wars, the making of the next global crisis, Jim Rickards of JAC Capital argued that the world was heading towards currency wars and the dollar would lose its status as the reserve currency of the globe. So, Jim, I read your book. I enjoyed it. I thought there's some fascinating stuff in there. Are you surprised, though, that after a third round of quantitative easing and the Fed saying they're going to keep rates at zero ad infinitum, that the dollar is holding up as well, relatively speaking, as it has?
Well, this is the essence of currency wars. The U.S. wants a cheaper dollar, but just because we want it doesn't mean we're going to get it because people push back. That's one of the fallacies of currency wars, is that you can unilaterally change the terms of trade, cheapen your currency, and promote your exports and create jobs. It never works out that way.
Because it presumes everybody else stays static.
Correct,
right?
but that's exactly right. But that never happens. The Chinese pushed back in 2010, 2011. Now, what's interesting is the currency wars have gone global in the sense that we're now seeing pushback from Brazil, Taiwan, Mexico, Hong Kong, other countries.
South Korea as well.
South Korea, that's exactly right. And I saw a story the other day reported that holdings of U.S. Treasury obligations by Brazil, Taiwan, Hong Kong, and Mexico had increased. And this was sort of read as a bullish story. Oh, look, there's a lot of confidence in the U.S. But in fact, this is how you fight the currency wars. You're shorting your own currency because you have to sell your currency, buy dollars to buy the treasuries. And so piling into treasuries is exactly what the Chinese did for 10 years. It's how you keep your currency cheap. So far from a vote of confidence in the U.S., it's actually another round in the currency wars.
Essentially, these countries are doing a carry trade in their own currency to buy the treasuries.
That's right. And whenever you're buying treasuries, you need dollars, so that tends to put a floor under the dollar. Now, Bernanke, of course, gave a very, I would say, blunt and threatening speech at the end of September at the IMF meeting in Tokyo, and he warned these other countries. He said, well, you have two choices. You can fight the currency wars, in which case we're going to keep printing, and you're going to get inflation because you've got to print your own money to soak up the dollars, or let your currency appreciate, and then you won't get the inflation. But of course, implicit in that is their exports go down because they're going. So he
basically said you can delink from the dollar if you want.
Right.
You know, if you don't like what we're doing, have your own monetary policy.
That's right, but it's not a free lunch because it means you have a stronger currency. The dollar gets weaker. So, but what Bernanke said, reading between the lines, he said, do what you want, but we're going to keep printing until the dollar gets weaker. So your choices are inflation if you want to keep a peg, or higher export prices if you let your currency go up. But kind of two bad choices for our trading partners. What it means is more printing. They're doing $40 billion a month. That could increase. They've never said that was the interim announcement. They never limited it to that. And there's no time limit on it. And they could go back to intermediate term treasuries. So this has got a long way to run. When I studied currency wars to write the book, one of the things I came away with is we're not always in currency wars, but when we are, they last for a long time.
Okay, because I was going to ask. I know timing these things is difficult, but at what point do you think all the money printing that the Fed is doing catches up to it? Because again, I think a lot of our viewers certainly are surprised by the fact that the dollar's holding up as well as it is. That gold, although it's doing well, is still below its high, much less below $3,000 or $5,000 an ounce. That many of our guests have come on and said that's where gold is heading.
Right, I agree that's where it's heading, but not all at once. You're exactly right. Look, as I said, the Fed wants a cheaper dollar, but doesn't mean they're going to get it. But if they don't get it, they'll just have to try harder.
Right.
So when I see, and by the way, if things play out as I expect with Iran and Israel, the dollar will get even stronger because there'll be another flight to quality. So your question now is when do the chickens come home to roost?
Exactly.
There are two catalysts for that. If our trading partners actually do let their currencies go stronger, watch the cross rates. What that means is we'll begin to import the inflation. We've been exporting inflation abroad. We will re-import that inflation through the exchange rate mechanism. That'll feed into the supply chain. So that's one catalyst. The other catalyst, there comes a time because the key to inflation is it's quantity theory money times velocity. Fed can make money whatever they want, and they have. Velocity is a psychological variable. So that's prone to very sudden shifts. Right now, people would rather put their money in the bank than go out to dinner, but that can change very quickly. So the combination of inflation in the supply chain and a change in psychology means that instead of the nice smooth path from 2% to 3% inflation that the Fed wants, it could gap to 6% in a matter of months.